Let us start with the number that makes people uncomfortable. The level of government debt in the United States is so large that most people cannot even visualize it. Trillions upon trillions in obligations, and that is only the visible portion. When analysts begin adding long-term commitments, such as retirement benefits and healthcare promises, the future obligations grow far beyond the headline figure. Some economists argue that this is not just a temporary budget issue tied to one political cycle. They see it as a structural challenge that has been building for decades. Here is where the conversation becomes controversial. There is an ongoing debate about whether traditional solutions are enough. Higher taxes, faster economic growth, and spending reductions are the classic tools. But critics of the current trajectory say that even optimistic assumptions struggle to fully close the gap between what has been promised and what can realistically be funded. That does not mean collapse is certain, but it does suggest that policymakers face very difficult trade-offs. One perspective gaining attention is that inflation can gradually reduce the real burden of debt over time. This is not a new idea in economic history. When prices and wages rise, old debt issued in the past is repaid with money that buys a little less than before. Some analysts describe this as an indirect adjustment mechanism built into modern monetary systems. Others strongly disagree and believe inflation can be contained without relying on currency erosion. The key takeaway is not panic, but awareness. Debt dynamics influence interest rates, policy decisions, and the long-term value of money. Understanding that debate helps viewers see why inflation, central bank policy, and government budgets are so closely connected in today's economy. Building on that idea, the next layer of the discussion is how inflation affects different groups in very different ways. Many people think of inflation as just higher prices at the store, but some analysts describe it as something deeper, almost like a slow shift of economic weight from one side of the system to the other. In this view, inflation does not hit everyone equally. The impact depends on what you own and how your income is structured. Imagine two households living in the same city. One keeps most of its wealth in cash savings and low-yielding fixed income products. The other owns shares in companies, maybe a small business or property that can generate rental income. When prices across the economy rise, the value of money in a savings account may not keep pace. Meanwhile, companies can often raise prices, property values may adjust, and business revenues can grow in nominal terms. Over time, this can create a gap in outcomes, even if both households work equally hard. Historically, societies have faced similar dynamics. When governments carry heavy debt loads, moderate inflation can reduce the real weight of past obligations. The numbers on paper stay the same, but the purchasing power behind those numbers changes. Some experts argue this acts as a kind of quiet adjustment compared to direct tax increases, which are highly visible and politically difficult. It is important to note that economists debate how intentional or controllable this process really is. Still, understanding this perspective helps explain why asset ownership, wage growth, and inflation are often discussed together. It is not simply about rising prices. It is about how the structure of the financial system distributes gains and losses over time, sometimes in ways that are easy to overlook day to day. When you connect these ideas, another question naturally comes up. If inflation affects asset owners and savers differently, what are the people running policy actually able to do about it? This is where the discussion shifts toward the relationship between government borrowing and central bank decisions. Some analysts describe the current environment as one where policy choices are more constrained than they appear on the surface. Governments around the world have taken on large amounts of debt over many years. When debt levels are high, interest rates matter a lot. Even small changes in borrowing costs can significantly affect how much governments must pay each year just to service existing obligations. Because of that, some observers argue that keeping rates elevated for long periods can create stress, not only for households and businesses, but also for public finances. This creates a difficult balance. Higher rates can help cool inflation, but they can also slow growth and increase fiscal pressure. At the same time, Central banks are designed to operate with a degree of independence. Their mandate often includes price stability and financial stability. However, in real-world conditions, economic, political, and financial systems are closely connected. When markets become volatile or growth slows sharply, there is often pressure to support stability. That support can come through lower rates or more accommodative policy. This leads to the idea, debated among economists, that there may be a long-term tendency toward easier financial conditions during periods of heavy debt. It does not mean decisions are simple or one-dimensional. Rather, it highlights the trade-offs policymakers face between controlling inflation, supporting employment, and maintaining overall system stability. Understanding those trade-offs helps viewers see why monetary policy discussions often sound cautious, complex, and sometimes conflicted in today's economy. As this picture comes together, another piece of the puzzle appears in a place many people would not expect: the world of digital dollars. Over the past few years, stablecoins have become a major tool inside the crypto ecosystem. These tokens are designed to track the value of the dollar and are widely used for trading, transfers, and storing value on digital platforms. What often gets less attention is how the system behind them works. When someone buys a dollar-backed stablecoin, the issuing company is expected to hold reserves to support those tokens. Those reserves can include cash and highly liquid financial instruments. In many cases, government securities are part of that mix. This means that demand for digital dollar tokens can translate into demand for traditional government debt instruments in the background. It creates a link between new financial technology and long-established public finance markets. Some analysts see this as an example of how the financial system adapts. In earlier decades, foreign central banks and large institutions were the primary buyers of government bonds. Today, flows can come through a wider range of channels, including financial products that did not exist a generation ago. The people holding these digital tokens may simply want convenience, speed, or access to global markets, without focusing on how reserve management works behind the scenes. It is important to stress that stablecoins are still an evolving area, with regulatory, technological, and market risks. Still, this perspective shows how modern finance can create indirect connections between everyday users and large-scale funding mechanisms. It reinforces the broader theme that the global monetary system is dynamic, with new structures forming to support old functions like government borrowing in a changing digital landscape. When you step back and look at these forces together, it can start to feel like there are two different economic experiences happening at the same time. On one side, you see headlines about stock markets reaching new highs, property values climbing, and large companies reporting strong revenues. On the other side, many households feel pressure from rising living costs, while their paychecks do not seem to stretch as far as they used to. This contrast has led some commentators to describe a gap between asset-driven growth and wage-based income. In periods where prices across the economy trend upward, businesses often adjust by increasing the prices of their goods and services. Over time, that can support higher revenues and, in some cases, higher company valuations. Real estate can show similar patterns as replacement costs, rents, and property values adjust. People who hold these types of assets may see their net worth rise on paper, even if day-to-day life still feels expensive. For workers who rely mainly on salary income, the picture can feel different. Wage growth does occur, but it may lag behind broader price changes, especially in certain sectors. This timing gap can reduce purchasing power in the short term. It is not necessarily the result of a single decision or a broken system, but rather the interaction of labor markets, business costs, and policy choices. A simple comparison often used is between two individuals with similar earnings who make different financial decisions over time. One focuses mainly on low-risk cash and fixed income products, while the other gradually builds exposure to diversified assets. Over long periods, these choices can lead to noticeably different outcomes, especially in environments where asset prices and consumer prices move upward together. When you put all of these pieces together, the conversation shifts from what is happening to what an individual can realistically do. If debt levels, inflation dynamics, policy trade-offs, and asset behavior are all connected, then personal financial strategy becomes less about prediction and more about positioning. The focus moves away from trying to outguess every headline and toward building a structure that can function across different economic conditions. One common approach discussed by many long-term investors is broad asset ownership. Diversified stock funds are often used as a core because they represent claims on real businesses that produce goods and services. Over time, companies can adjust to changing price levels. Real estate is sometimes included for similar reasons, since property can generate income and may respond to shifts in the broader price environment. Some people add a small allocation to assets viewed as stores of value or alternatives, but the exact mix depends on personal goals, time horizon, and tolerance for risk. Just as important as what people own is how they behave. Regular, automated investing can reduce the emotional pressure of trying to pick perfect entry points. Markets move in cycles, and short-term swings are normal. Having a plan and sticking to it can help avoid decisions driven by fear or excitement. This is not about chasing quick gains, but about consistency over years and decades. A key takeaway for viewers is awareness. Understanding how debt, inflation, and asset markets interact can help people ask better questions about their own finances. There is no one-size-fits-all solution, and professional advice can be valuable. Still, building diversified exposure, managing risk, and maintaining discipline are widely recognized principles for navigating an economy that is always evolving.